Welcome to Our 2 Cents on Your Dollar, the podcast brought to you by Strategic Insights, where we break down the numbers, decode the noise, and offer smart takes on money matters so your financial future makes sense. Welcome, everyone. Today, we are going to talk about the Federal Reserve because they've been in the news a lot lately. Whether you're for it, against them, whether you want to tighten, whether you want to ease, whether you think rates should be lower, should be higher, we're going to talk about it all. But you know what? Let's just fast forward to the very end. Even though we're going to talk about all this, we think you should do nothing in your portfolio. And we're going to spend the balance of the time supporting our thesis behind that. So you know that we're just not some financial advisors that are just dismissing it. But why don't we start there? What is the Federal Reserve?
The Federal Reserve is the nation's bank, or you can say the bank's bank. They've been around since 1913 because of the direct results of the Panic of 1907. They regulate banks. They make sure they have enough liquidity. They make sure they are compliant with federal laws, and they control interest rates to monetary policy.
In that explanation, you said the nation's bank. Yeah. So do other nations have a nation's bank?
Yeah, they do. So we're not the only one. We're on the pedestal, like we're they look up to us. Yeah. But we have our own central bank, and so there's many other countries that have their own central banking system as well too, and they serve the same purpose.
We were actually one of the last ones to have a central bank. Because in theory, we believed in free markets, and we tried that for a little bit, and then the Panic of 1907 happened, and we decided to finally have a centralized bank.
Okay, listen, we're just going to dive right in. I'm just following y'all's lead. Y'all just keep setting them up. So you said we're on a pedestal. Okay, there's been a lot of talk about that, right? Fed independence. You know what? Let's put a pin in that. We're going to come back to that, but keep that in mind. Okay. Because I think we should understand what Fed independence means, who controls them, what do they control. I know they're the nation's bank, but what does all that mean? What do they control? Federal Reserve, it's often talked that they have dual mandate. What are those two mandates?
Yeah, since the 1970s, when we experienced high inflation rates, we're talking about double-digit inflation rates. It went up all the way up to 15% in the early 80s. The Federal Reserve has had a dual mandate of full employment and stability of prices.
Who does that? Because I know I've heard board governors, I've heard chairmen, So who's the one actually responsible of carrying out those mandates?
Yeah, so the Federal Reserve is made up of multiple individuals and parties. So there's a board of governors that utilizes market research, economic research, data from unemployment to pricing. There's a wide range of data usage that they determine where we stand from an employment aspect and where we stand economically. And so they utilize that data, and their responsibility is to maintain interest rates as far as what the direct lending that our banking system has from the Fed. So the overnight rates from the Fed to our banking systems. And so they control that, and they control that on a monthly basis or on a regular basis. And so their responsibility is to utilize that data, come together, decide conclusively how to continually and effectively move forward to keep us at low employment levels and keep price stability over time.
Is there a target unemployment rate? I know you said low unemployment rate. Is there a target?
Yeah, generally speaking, the Fed prefers an employment rate around 4%. And then for inflation, around 2% is the target for them.
I am so confused, guys, because y'all are telling me that the Fed is responsible for unemployment. I thought administrations were responsible for that.
No, this is an independent organization. And as you can imagine, it works better if they stay independent because they have to make very tough decisions that sometimes I don't think you can get passed politically. For example, going back into the 1970s and 80s when inflation was 15%, the chairman of the Federal Reserve at that time, Volcker, he actually increased rates all the way up to 20%. And this caused a recession that lasted about 16 months. It was able to bring down inflation, but you cause a recession. I don't know many administrations that will go up to the podium and say, hey, I'm going to be able to battle inflation, but I'm going to cause a recession first.
So, all right. So that leads into what are some of the tools that they utilize to stabilize prices? Is that one of them? You're saying that they increase interest rates when inflation's high?
That's right. Yeah, that's the general rule. If the Federal Reserve wants inflation to come down, they increase rates, and if they want to help the economy or boost the economy, they'll lower rates.
Wait, boost the economy, they'll lower rates.
Uh-oh.
Yep.
Does that mean if the Fed cuts rates, it could be a signal that the economy is weak?
Yes. So
Wow, he said it.
he said it. He went there.
It's for the viewers.
Yeah.
It's for the viewers.
Yeah.
Okay,
Yeah. So
Tell 'em.
So that's really the the difficulty in regards to the position that they're put in, because they have to determine, based on any interest rate changes that they make, there's going to be some type of direct influence economically, right? And so they're utilizing the data they have to determine whether we're in strong economic or weaker economic positions. And so if they're determining that it is a good time to start cutting interest rates, Fed rates, the reason for that is because they are seeing some type of weakening. And their response to that weakening is to shrink their interest rates to banks and allow for cheaper lending. And for that cheaper lending then provides a little bit of stimulus into the economy, helps with spending, helps with some economic growth. So it's a direct response, right, to the data that shows that there has to be some weakening, for them to make that decision that it's okay and it's appropriate to start cutting.
Who's the one making those decisions? We mentioned the board governors, you mentioned the Fed chair. Who's the one that's actually doing it, and how are these people being put in place?
So the president appoints, and the Federal Reserve chair ultimately has the final decision. But obviously, committees are getting together to make that determination based off of all the data that they're receiving. Some of these individuals have different regions that they oversee. Some of them have different sectors that they oversee, and ultimately, they all come together to basically try to make a decision what's going to ultimately be the best for the economy, not just today, but in the upcoming future.
Yeah, there's 12 regional Federal Reserve banks, and they them with the governors, they have a committee called the Federal Open Market Committee, and every 6 weeks, that's when you turn in the news, and the chairman Powell comes out and he tells you about the status of the economy and what they're thinking, and if they're going to raise rates or decrease rates.
As I say, all this is on the Federal Reserve website, right? There's a plethora of information in regards to how they're trying to evaluate, and they pretty much show information almost monthly on all these different metrics that they're tracking. And so, there's a lot of information on that website, overbearing.
Yeah, I'm probably jumping out of turn here, but there's a lot of information. So what are viewers supposed to do with all this information? I mean, there's so many headlines, like it almost seems like daily. So what are viewers, I kind of mentioned it, right? Like they should do nothing.
Yeah. Yeah, I think one of the key things that individuals should be aware of is what the changes in rates actually affect when it comes to them personally, right? And so this is an overnight rate that they're changing. So these are the when we look at the yield curve and we look at the durations on the yield curve, we're looking on the very, very shortest part of that yield curve. So we're looking at instruments that are very short term in regards to their terms, right? And so people start looking at Fed rates and they see these rate cuts happening with Fed rates, and they automatically assume, oh, the 30-year mortgage rates are dropping because the Fed are cutting 25 basis points. And these longer termed notes are going to have immediate impact based on these Fed cuts. And that's not necessarily the case. What you're going to see is you're going to see shorter termed instruments have more of an impact directly associated to these Fed cuts. So when you look at, hey, my CD is going to expire at the end of this month, and why I want to renew another 12-month CD, that CD rate is probably going to be affected by a Fed cut. Your money markets as well too are going to be directly affected by a Fed cut. These are shorter duration instruments. So be aware, just because there is a Fed cut doesn't mean if you're looking for a new mortgage and you're looking at 15, 30-year mortgages, that those mortgages are automatically going to get cut, basis point to basis point based on that Fed cut. Because you want to look more at 10-year Treasury yields. Those have a little bit more correlation with your mortgage interest rates. But be aware as far as what the actual direct impact is for those.
Okay, so if the Fed is not setting the 10-year rate, which is often an off-cited benchmark,
Right.
and they're not setting the 30-year mortgage rates, what is impacting those rates?
They have a couple of or several tools that they use I was going to say manipulate. Just kidding. Just jokes. To impact. I like your words better. Affect. Any other words I should use besides manipulate? Oh. Well, one is the discount rate. We mentioned earlier that the Federal Reserve is the central bank. It was designed to be the last resort for banks. So it has the discount rate. That is the rate that they set for banks to get loans. And they prefer that to be higher than the federal funds rate, which is the rate that banks lend each other for overnight loans. So they prefer that the banks lend to each other. And if that's just not working, then you can go to the Federal Reserve and the discount rate is higher. That's usually set 25 to 50 basis above the federal funds rate. And then from the federal funds rate, there's the prime rate, which is the rate that banks charge their most credit-worthy customers, and that's usually set 3% above the federal funds rate. So you can start to see how when they adjust these two rates, it kind of overflows to other rates, to your credit cards, your personal loans, your mortgages. But they don't directly cause an effect. They have to work with these two rates that they have in their hands. Yeah.
Since you mentioned tools about the Fed, what does it mean when we hear them say that they're shrinking their balance sheet?
Yeah. So what they're trying to do is they're trying to either raise money and capital or take on more debt. So they have a responsibility and looking at from an economic position. Cash flow throughout our economy and being able to really add cash into economy and help continue to provide stimulus and provide growth, or start to lower it and start to shrink it because of inflation issues. And that's what typically happens, is that we'll see higher levels of inflation when there's too much cash and there's too much cash flow. People have a plethora in regards to just general spending. And we have a shortage or some type of supply chain issue or some type of reduction in regards to manufacturing. And so our supplies become shrunken and we have too much cash flowing, economically speaking. So what they'll do is they'll try to offset that by lowering the easeability and accessibility of cash into the economy. And vice versa, they have the capability of trying to do that both ways, right? If they want to add cash into it or they want to kind of bring it down, they can do that by utilizing interest rates and utilizing other tools as well.
Yeah, like I mentioned earlier, the discount rate, they set that. And as Leah was mentioning, what they're messing with is the federal funds rate. And they do that by if they want to increase the amount of cash that's going to be within the banks and in the economy, they'll buy treasury bills from the banks. And if they want to reduce the amount of cash that's in circulation, they'll sell treasury bills to the same banks. Okay. Yeah, and that's how they're able to move the interest rates.
Yeah, people don't realize 2020, that was one of the biggest tools that they really implemented, not just significant rate cuts, but they bought billions in treasury notes during that time frame. So it was a direct overnight cash flow, like really kind of just bolted into the economy right there and then. And they have that tool and that capability to do that instantaneously. So they can flush billions of dollars right back into these banking systems, and really, really add cash onto the books for them, and or alleviate cash onto the books for them as well too.
And they can also just buy them back too, and then just not reissue them, right? And so that's another way they can kind of offset it, go the opposite direction.
Okay. Yeah. Okay. So is one of their things to that point about buying bonds, well, obviously the government has to pay interest, right? And a lot of people say that if the interest rates were lower, it'd be better for the economy or the deficit more specifically. Is it the Fed's responsibility to lower interest rates so we run at less of a deficit?
No, it's not their mandate. No, not at all. Yeah, and even then, when you look at the government budget, it's increasing, but right now about 12% of the government's budget goes towards paying interest.
Mm-hmm.
So there's other things you want to take care of if you really want to aggressively reduce our deficit and the debt.
I think it goes back to their independence, right? That's not their main objective.
Okay, since you mentioned independence, I want to go back to what you said earlier, right? That we're on a pedestal. Not my words, his words. Yeah, I've seen in the news recently that some other central banks are cutting rates, and so the administration has used that to pressure our current chair. And you hear some people saying that the Fed needs to maintain its independence because we are the star in the world.
Gold standard.
The gold standard. Okay, I didn't say it, you said it.
They not like us.
Wow.
He would say that.
Yeah, him, not me.
Or Kendrick.
Can you all provide some color around that?
Yeah, I mean, it's difficult to compare our economy to these other economies, right? Especially because, the way we spend in general, we're really good at it, just in general. It doesn't matter the scenario. I mean, we've gone through different economic crises. We've gone through higher inflation.
When you say the way we spend, who are you?
Americans.
Okay.
Yes.
As a country, not
as a country. Okay. As a country. Yes. So U.S. citizens in general.
The citizens or the government?
Both.
Okay. No, I mean just important clarification.
Yeah. No. Both. We are one of the largest importers, or we are the largest importer of goods across the entire world. So our spending levels are astronomical, and so we've had higher inflation and interest rates for like longer periods of time, and we've seen small dents in total spending over those periods of time, because no matter what conditions are, we typically see it takes a lot for Americans to start slowing down their spending overall in general. And so when you put us in a position where it now becomes easier with cheaper borrowing and more cash flows into from just economic purposes, we'll continue to spend it. And so the independence of the Fed is so important, not to take into account what's going on in other economies in other countries and other nations, and really focusing on, what we're dealing with, what the current circumstances are, where we're at from an unemployment aspect, where we're at with consumer spending, where we're at with inflation, and looking at key critical numbers locally and utilizing that data to determine appropriateness in what they do and how they determine where we stand interest rate wise. Because as soon as you start assuming and looking at other countries and why they're doing these certain different things and taking that account and letting that influence decision making here, you can get into scenarios like we had in the 80s. And we get back into these higher inflationary positions, right back where we were just a couple of years ago. So the importance of maintaining that independence, not letting the political turmoil and political chirping influence your decision making, it's extremely difficult, and I mean, albeit for these Fed chairs to really kind of maintain their independence and really block out that noise, but becomes a difficult position for them, and I think where we stand right now, we've seen that really stay true for a long period of time.
Yeah, hey, you know what? This might be an unpopular take, but man, Jerome Powell, Uncle Jerome, he's a real one. He's a real one, man.
I don't know if that's unpopular really at all. I mean, we've seen what.
Hey, I think he's doing his job right. He's supposed to protect the consumers, supposed to protect the financial institution, right? He's avoiding all the other noise. He's saying, "I'm gonna stick with those."
I was kidding when I said it. That was Alexis Villarreal.
I said it. I said it.
I said, not very
Fell
popular
into
right
the
now.
trap.
Took the bait.
I didn't say it once again. He did.
Once again, apolitical. Okay. We have
trap.
yeah, don't step there. Okay, we only have about 8 minutes left. So, all right. So over the last few years, when rates started going up, right? You were. I don't know about you all, but I was hearing a lot of people. I'm sure y'all heard the same people say this. That if I can get 4.5% on money markets, like I don't really know where the stock market's at right now, so I'm just gonna wait it out in cash. So it stands to reason that if those rates come down, maybe people are gonna start investing in equities. But you all just educated us that if rates are being cut, the economy's weak. So what is a person to do?
I think you mentioned it earlier. Well, it kind of depends on your strategy. Are you trying to be strategic and be a long-term investor, or are you trying to be tactical and take advantage of different price movements within different asset classes? So it just depends on what you're trying to do and your philosophies. Yeah.
Yeah, for the most part, right? Do nothing. There's not like,
But why?
Yeah.
I said that. Why?
For example, you mentioned that the economy is weakening, and that's why the Federal Reserve is reducing rates.
I didn't mention it.
But the stock market is up,
Right.
and so you have to kind of, that should be, when you think about it, that should be correlated. If the economy is weakening, the stock market should be down. But as of right now, it's up. So for those who are long-term investors, this is a reason why you would, cut out the noise and just invest for the long term.
So you're saying even though the economy is weakening, the stock market can continue to increase, and that's why you shouldn't do anything.
Right.
Yeah, I think like any economic cycles that come around, right? Different scenarios create different opportunities, right? They're always constantly changing, and so trying to be a strategic investor, right? You're going to have to be right all the time in all those changes that you're making. We take the approach of being long-term investors and being, making sure you have emergency funds, make sure you have your, short, medium, long-term aspects of it to be able to handle all the noise that ever happens, because there's too much that's happening that's changing. And so even though that rates are coming down, that's giving companies an opportunity to borrow at lower rates, so that gives them some flexibility. It puts a boost in their stock prices, not necessarily saying that they're doing better, but their prices go up when this happens. Does it always stay that way? They'll fluctuate, but I think over long periods of time we've seen that the stock market yields high rates of return, way better than any sort of money market or CDs.
Yeah, what we've seen in cutting rate environments is a really positive response in the bond markets. And so I think that is something that we have seen high correlation with, typically and historically speaking. So even though during the past couple of years, right, as of we're recording right now, bonds haven't performed the best with these higher interest rate and Fed's raising rates over that time frame. Now is the time that you can start to look at the bond portion of your portfolio and start to determine, okay, am I allocated appropriately for a decreasing interest rate environment? And how do I take, if you are wanting to be a little bit more tactical, how can I take advantage on the fixed income side for a lowering interest rate environment? Because there is more correlation with fixed incomes with interest rates than there are on the equity side.
Yeah, when you just think about, rates going down, just stepping back a little bit, that means the Federal Reserve is buying treasuries. So there's more liquidity into the system, lowers rates, which means borrowing for smaller companies and companies in general should go down. So theoretically, small companies and even technology companies should benefit. But if you're a tactical investor, now you have to kind of make a decision. Technology stocks have done so well for over a decade. Are they overvalued? And the Federal Reserve has reduced rates. Are they going to continue? And so you can be tactical, but it makes it a little bit difficult in the short term. And then as we've seen when the Federal Reserve was implementing quantitative easing post 2008. We heard a lot of things about the currency is gonna go away, and so in that situation, typically gold does well. So those are kind of things you have to consider if you're trying to be tactical. But if you're a long-term investor, choose a risk profile, rebalance, and yeah.
Since you brought it up, is the currency still around? The U.S. dollar? That was 2008, so that was like 17 years ago.
Yeah.
So, I mean, by now, that's a long time.
I don't have any cash in my pocket.
I mean, I just thought about it. Once again, just mentioning the importance of the independence of the Federal Reserve. During that time with quantitative easing, we were not only were we keeping short-term rates at zero, we were keeping long-term rates at zero. So I don't know if our viewers remember when you turn on the radio, watch the television, there was so much ads about gold because there was a lot of speculation that the U.S. currency would disappear. And so if you were very, very tactical and you completely just went to gold for a long time, it was a little bit painful to hold. You've had some returns recently. So those are kind of some of the challenges you're going to have if you're trying to be tactical.
Yeah, but some could argue that we've had a run up in gold because of inflationary times.
Right.
Yes.
Yes,
that's a really good point.
Some could argue that.
I think most do.
Some.
He said it, man. It was his idea.
Remember, impartial host,
Apolitical. Just two guys on the outside.
not pointing any fingers.
He wanted me to say it.
You have to consider like a lot of these smaller term, medium-sized companies have high leverage, and so they're holding this leverage over longer periods of times. They are hoping that these interest rates come down, but a lot of these companies have performed really well even with this higher leverage that they had at higher rates, and so it is difficult, like you said, from a tactical position because they've performed well in these environments, and so now the expectation is okay. Now their debt's going to be cheaper, so it should be good for them, but the reason their debt is getting cheaper is because the economy is slowing down. So it's such a tough thing to juggle and try and figure that out. I don't recommend it.
Right. Well, okay. To that point, I got to get this one in.
Yeah,
All right.
yeah.
So we just had a jobs report, 12-month jobs report revised again.
No, not again.
Another one.
Another one. The Fed's job is to control unemployment. How are they supposed to control unemployment when you don't even have good information? And then on top of that, how am I, as the individual investor, supposed to be tactical to get better returns if I have lagging data?
I knew you were gonna say.
I had to. You brought it up right before we came on. So
Yeah.
It's old news at that point, right? I mean, that's a problem with it. Anytime that there's information that's coming out into the system, the market's ahead of that, and so I think it makes it very difficult to be tactical, right? It's a flawed system, and as long as it's a continued lag in the system, your information that you're having is past news, and it's not going to benefit you. You're going to be making decisions after the fact.
Yeah, but you can always just talk about your wins.
Yeah, that's it. I know. Only the W's.
It's like the Bears last night.
that was it. We don't know when it was.
No.
No idea.
Okay. I think that was a good mic drop.
Yeah.
I mean, you heard it here. Alexis Villarreal. It's a flawed system. So if you want to fix it, reach out to him. Make sure you follow, like, and subscribe.
Yep. Thanks.
Thank you for joining us on Our 2 Cents on Your Dollar, proudly presented by Strategic Insights. If today's conversation brought you clarity, please pass it along and don't forget to subscribe, share, and check the description below to learn more about us. Until next time, stay informed, stay invested, and stay strategic.